So financial forecasting and financial analytics is often considered pretty strategic, and strategic decisions are like driving a car. So you need to be able to look back and look ahead. And if you're not looking back, it's really difficult to drive your car safely and make good decisions here. And let's jump to the next slide here. And financial analytics is exactly the same. And basically, if you're looking to the past, you're looking at lagging indicators. And if you're looking to the future, you're looking at leading indicators. So lagging indicators basically tell you what has already happened. Those are the top line numbers that are the end result of something. So for example, revenue, your gross margin, your churn, EBITDA, headcount, etc. Those are the main financial numbers. And in order to get there, in order to produce those numbers, you usually need leading indicators that then drive revenue, drive gross margin, etc. And leading indicators are usually headcount analytics, staff cost forecasting, for example, your sales and marketing expenditure to actually generate leads, and then you're doing sales and revenue forecasting based on your sales team headcount, your sales expenditure, your marketing expenditure, that then all of this will impact your future revenues that will then become your lagging indicators later on. I was wondering if Reima has any comments on this part here.
Yeah, that's of course. As an investors, we invest in future, and for that reason, of course, the leading indicators, not the indicators as such, but what you have used to build your forecast. So can we see when we start diving into the forecast, can we see that does it make sense? So basically, roughly, you can say that there are three ways of doing forecast. One is just you throw out the number. Well, not really reliable. I need to redo it as an investor. Or then you say that, okay, if we only get 1% of the market, well, okay, if there is a way to get that 1%, then it makes sense. But if you build it bottom down, basically saying that this is the amount of money it takes to get one new customer, this is the amount of money we're going to invest in customer acquisition, this is the lead time, then the forecast is already a lot more reliable. Quite often in due diligence, we also ask some of the lagging information, but that is not as much on the that we are cared about that what was the expenses or revenue a while back, but it's more reflecting because everything you do is reflected in the numbers. If you invest in R&D, you can see that you have employment expenses, for example, or you have capitalized development expenses. So if your story says that you have done something, we looked in the past numbers just to see that whether that has happened or not.
Exactly. The next couple of slides will actually explain quite well that as well, just to kind of see the loop between the lagging indicators and the leading indicators. In financial analytics and growth metrics, everything is connected. So basically, you should be connecting or linking your lagging indicators to your leading indicators. And in order to actually build an automated financial forecasting or reliable cash flow forecasting or revenue forecasting, you need to link your sales funnel and your staff costs and headcount forecasting to your revenue forecasting, for example. So that's why you're basically creating a full loop, and you change only one variable there, and it changes the whole forecast. It should be basically that easy. And if we jump to the next slide, we have a practical example of that. So this for example explains revenue forecasting. So revenue forecasting is you basically started with your current actual revenue, and then you start thinking, okay, how many deals you need to close to basically get to your forecasted revenue. And then you start thinking about, okay, how much money do I need to spend to get there? How much money do I need to spend on sales tools and for example, LinkedIn advertisements and Facebook advertisements, etc. And then you need to think about, okay, how many salespeople do I actually need to close those deals? And then what's the sales cycle time? And then you actually get your revenue forecast. And then you can compare that revenue forecast to your actual results later on. And then it basically creates a loop. And then at the same time, you've done most of your cash flow forecasting, you've done your headcount analytics, you've done your customer acquisition cost forecasting, etc. when you've actually thought about the revenue forecasting. So everything is really connected over here. So this is exactly what Reimo was explaining earlier on. Would you have any comments on this, Reimo?
And I think this is something that cannot be underlined enough. So this is a tool really for you to drive the business. So once you get these metrics in place, then you can start looking into that. Which are our bottlenecks? Is it, for example, sales or marketing? Is it closing the deals or lead generation? Which is the one where I should put more resources? How much? And even more detailed in which channel? And once you've got this cracked open, it means two things. One is that you can really drive the growth of the company because every euro or dollar you get, you can invest in growing the company. But also, when you have reached that point, it's very easy to come to investors saying that, look, here's our model. So basically, if you invest 1 million, we will put it here, here, and here. We will acquire this and this many customers, which will pay back the acquisition cost within this and this time frame, plus make a profit of this multiple. So basically showing that the case is scalable. So one of those moments that if a founder would come with a model like this to me, basically showing the right metrics, right number, it would really be, okay, shut up and take my money and start doing. That's pretty much clear at that point that you have a scalable business.
Yeah, that's a really good example. Let's jump to the lagging indicators, and let's go through the most important lagging indicators. After which we'll go through the most important leading indicators as well. So as we explained earlier, lagging indicators are the historical results of your company's performance. So they can be revenues, they can be gross margin, churn, etc. And then you use those lagging indicators to build your forecast. So basically the actual result or the historical result is always the starting point to your forecast, and then you can build your financial plan accordingly. So let's jump to the first example here, which is actually let's make a list first. I skipped one slide. So we're going to be looking at 6 examples here. So we'll be looking at revenues, gross margin, average revenue per account, churn, EBITDA, and headcount. And we can look at the first one, which is revenue. And here, for a SaaS company, the most important revenue metric is the monthly recurring revenue, the MRR, which is basically the total amount of your subscriptions, total value of your subscriptions. And then that really helps you to understand your scalability, because recurring revenue is, well, by default recurring. So basically, if you have a low churn, you can forecast your future revenues really well by just getting your sales funnel and marketing funnel just correct. And this is one of the most important metrics for investors and for the startup founders as well, because that's the end result of pretty much everything you've done in the company, whether it's R&D, whether it's sales or marketing or customer success. They basically all have an impact on revenue. And next slide is more the investor's point of view. So I'll give the floor to.
Yeah, so as it says in the slide, it's and as Niko was saying, I'm not sure if MRR is the most important, but it's the first one we're gonna look into. So basically saying that where the company is today, that gives you how much there is traction. And of course, it varies from one investor to another, how much we want to see traction. Some don't like to need to see it at all. For example, for us at Trind, it's important that the company has significant traction. So we are talking about tens of thousands in MRR that we like to see. But this is sort of the starting point. In future, more important is the growth rate of the MRR. And in SaaS business, that is really the metrics. If you are growing your revenues by selling services, that really doesn't drive the value. But if we see a growth in the recurring revenue, then it means that the value is going up. And you can pretty easily find there are tons of sources that tell you about the correlation between the valuation multiples and growth rate. So sort of as a rule of thumb, you can say that the annual revenue growth rate times the monthly recurring revenue is roughly the valuation of our companies.
Perfect. Let's look at the next one, which is gross margin here. And gross margin is one of the most important profitability metrics, and it also drives valuations. For a SaaS startup, gross margin target is somewhere between 70 and 90%. And gross margin is simply your revenue minus your cost of sales. Cost of sales can be, for example, transaction fees, they can be cloud expenses, they can be, for example, customer success expenses. And then in the end, basically, it's your net revenue or your net gross margin that's left there after you deducted your production costs from your revenue. And then if you compare, for example, two different companies, one has a 50% gross margin and the other one has 90% gross margin, and their growth rates are the same and the revenues are the same. The company that has a higher gross margin has a significantly higher valuation as well, because it means that you can basically scale your revenues really efficiently and be profitable as well. But a lot of early stage startups, the gross margin is not necessarily very healthy because then the revenue level is quite low and you've invested a lot of money, for example, in your team and your R&D. So then in the first year, it might not make a lot of sense, but then after that, it becomes really, really important. Reima, any comments?
Yeah. And I think you said on SaaS companies, the gross margin is above 70%. I would say that it should be in most cases over 85 or even over 95. So basically, if you are selling software as a subscription, you shouldn't have that much of a production cost, that much of a cost of sales there. But of course, in some cases there are. And this is important to understand that quite often in evaluations, you compare the MRR multiples. And like Niko was saying, if your gross margin is not 100%, then you're comparing apples and oranges unless you take the gross margin into account. And most often, in cases of SaaS companies, I see the difference that you are basically valuing with a MRR multiple. But at the same time, your MRR is more of this kind of cross merchandise volume. So, for instance, you are giving a big chunks of commissions to some references or whatever that causes that there is actually very high cost of sales. So in those cases, actually, you shouldn't even be looking at the MRR level, but more on the what is the gross margin, gross profit that is left out of that MRR. And that can easily, if it's 50%, it means that your valuation drops in half, plain and simple.
Yeah, exactly. Let's look at the next lagging indicator here, which is the average revenue per account or average revenue per user. And here, what I usually look at is the trend line over here. How has the average revenue per account evolved over time? How does it look in different cohorts or segments or geographical locations? Like, for example, how is your German MRR and ARPA compared to your American counterparts, for example, etc. And then the evolution here is key, because then we use ARPA in so many different SaaS metrics, like, for example, CAC payback times, LTV calculations, etc. So it's kind of like the fundamental metric for a lot of other metrics as well. So that's why it's necessarily not the most important metrics per se, but it's one of the most important pieces of other metrics as well. So that's important to right over here. And how you calculate ARPA is basically you just take your MRR and divide it by your customer count, so that you can do in different segments for different countries, different customer groups, etc. So you can basically make a lot more sense out of it and then compare those different cohorts as well. Reima, how would you use ARPA here?
As you said, it's as ARPA thoughts is sort of a figure as such is more on tool to build something more. So something that you look into when you start to calculate your, for example, customer lifetime value, or something that you use when you start to calculate that what is the customer acquisition cost payback time. But maybe one thing that I want to mention here is that even though the calculation formula Niko gave is 100% correct, but as he was saying, you can do this in multiple different dimensions on certain customer groups or verticals. So you actually should do, because the averages can be very deceiving. So thinking about that, you have a bunch of large customers, bunch of small customers, you take ARPA, it goes closer to the large customers, to a group where you have no customers. So it actually gives you false understanding on your customer profile, unless you divide it into a smaller clumps, like for example, separating small customers and enterprise customers.
Exactly. All right, let's look at the next one, which is churn. And this is I could give a lot of CFO calculations or CFO terminology for churn, but this is I would probably want to hear more the investors' explanation of churn and why it's important. So I'd like to give the floor to Reima to explain churn.
Okay, thanks. No, it's churn is of course what we are looking into is sort of that two things. One, once again, what is the customer lifetime value? But most importantly, it's the first indication of product market fit. So many people think that it's the customers buying that is the first indicator of product market fit, but it's actually customers staying. And churn is the number that tells you whether your customers are staying or leaving. And there's no rule of thumb, because it really varies on what kind of customers you're having. So for instance, if you talk about gaming company, if they churn 50% of the customers in 1 year, it's still a good game. Whereas if you talk about B2B SaaS software, if they churn in 1 year 50%, it's a nightmare. One thing that I would keep in mind here is that which churn you're actually looking for. So are you looking for so-called logo churn, so the number of customers that are churning? Or are you looking into the euro churn, so the amount of money, euros, dollars, that is churned? And of course, if your average churn relates to average customer, then it doesn't make sense. But like I said in the previous slide, averages are dangerous. It might be, for example, that your product is excellent for SMEs, but still when you're looking at euro churn, you see that, hey, that's so big churn, we have a problem, we need to do something. And while the correct solution probably would be to forget the large customers, focus on the small end, you actually ended up trying to add some stickiness elements to your product. Over to you, Niko.
Yes, thank you for that. I think it's a great explanation for churn. And the next slide is you hop on there. Yeah. So yeah, basically, product market fit, as Reima explained, is basically a combination of revenues and churn. And EBITDA is one of the interesting profitability metrics as well for not necessarily for a startup, but little bit more evolved and mature companies. So usually you're looking at both gross margin and EBITDA. And EBITDA is often one of the key valuation drivers for a more mature company. And then for a startup, it actually can be even negative if your sales and marketing expenses are very high and companies growing really quickly, and then It's basically investing a lot of money on growth. EBITDA might not be the most important metric over there and in that kind of growth phase, but for a more stable company, it's a really good metric of cash flow positivity and then profitability as well. And it simply stands for earnings before interest, tax, depreciation, and amortization. Basically tells you that, okay, how much money you still have, left in the bank after you've paid out your expenses. And then Reima can probably tell the importance or the not so much importance for early stage startups here.
Yeah, so as Niko was already saying, it's when you go to the private equity deals or when you go to the B rounds, C rounds, then the company valuations are usually EBITDA multiples or normalized EBITDA multiples. But when you are in the early stages, it's not very feasible metric because it's most likely negative. In most cases, it is. But there's something to keep in mind that you need to be able to show positive EBITDA in the future. You need to be able to build growing, strong EBITDA in the future. Otherwise, your company won't have value. So in that sense, understanding it makes sense. And one other element is that you can, so even in earlier companies, use it as a guideline on how much you want to run into a loss. So there is something called rule of 40, basically meaning that your annual growth rate plus EBITDA should be, as a percentage, should be above 40. So if you are growing 100% per year, you can afford to make 60% loss. There's no science behind it. It's just sort of a rule of thumb that a lot of investors using. And actually, we want the companies to be negative. We want them to show the red numbers on EBITDA because we want them to be growing as fast as possible.
Exactly. Yeah. Sorry. So here, basically, you're looking at two different scenarios. One is a more mature company that's kind of growing in a stable way, and they're not investing that much money on growth. And then there's the startup that's looking for the hockey stick effect, that is investing a lot of money on building a sales team, investing in new markets, spending lots of money on online marketing, for example. And then that means that you can and probably should have negative EBITDA in that very intense growth stage.
And basically that is from the investors, that is the difference whether you have venture capital, so meaning that you're gonna run on a loss, or if you have growth capital or private equity, which means that you aim for maximized growth of your EBITDA.
Yes, let's look at the next one, which is headcount. And then this is what drives a lot of the startups expenditure, because especially in the first years, startups expenditure is very much headcount driven. So your engineers, your salespeople, your marketing people, customer success people, etc. And then when you're doing headcount planning, you're also doing staff cost forecasting. And when you're doing staff cost forecasting, you're basically doing customer acquisition cost forecasting, and you're doing revenue forecasting as well, because then you're linking your headcount and your staff costs to your sales funnel and how many deals are you closing with the sales team, for example. How many leads are you generating with your marketing staff and with your marketing expenditure as well. So headcount is one of the key underlying metrics for any kind of financial plan, especially for a startup, because the startup has mostly headcount expenses over here. How would you, Reima, see headcount and staff cost forecasting for a startup?
Yeah, it's well, you pretty much opened it all already. So it's not about I'm not caring about how the headcount will grow, but what I will care about is that how many people in sales teams I need to close the deals in our time frame. How many people in development I need to produce the outputs, the milestones that we have planned. And that's sort of I think the recruiting and the right timing of the recruitment is probably one of the biggest challenges in early stage startups, that you either end up hiring too soon, meaning that you don't have enough cash, or then you are hiring too slowly, meaning that you are not growing as fast as possible. And I've seen some companies very aggressively looking into and forecasting when they're gonna make their next recruitment. So the new employees have actually been very core part of their financial forecast. And as soon as they hit certain revenue goals, they are looking into the next recruitment just to keep the pace of the growth growing.
And I've heard many people say that one of the most important things for a CEO is to keep a candidate pipeline as well hot all the time. So then when you need to hire a new person, you basically just go through your contacts and then you contact the 5 most important people that you've already talked to in the past, and then try to figure out which roles would they fit. Because startup will have always new roles, and pivots, things change, new roles open up, and then if you have a hot pipeline of good candidates, you can just always call them and then ask them to come. But then that's a very time-consuming process there. But then it would be great if all startups and all startup CEOs would have that kind of pipeline open for candidates as well. We have been looking at lagging indicators now. So those are basically the indicators, the metrics that already happen. Those are usually the most important numbers in the financials. And then now we'll be basically looking at leading indicators. So the future indicators of a company's success that will then impact lagging indicators later on. And then this is usually the leading indicators are where the kind of magic happens for growth. Like, how do you do your sales forecasting? What does your sales funnel look like? How many deals are you closing? And what kind of expenses you need to have in order to perform and close those deals. And then we'll have a couple of practical, interesting examples over here. So let's go to the next slide. So yes, so this is what I just explained. So we can hop on to the next one here. And we'll be looking at headcount and staff cost forecasting. We'll be also looking at sales and marketing expenditure forecasting. So that's basically your sales expenses, marketing expenses to actually generate leads. And then that will all end up in sales and revenue forecasting as well, which then, for example, will generate your revenue forecasting, which later on becomes your lagging indicator over there. So let's take the first example there. So when you're planning your sales and marketing expenditures, that usually means that you're thinking about how many leads you want to generate in which channels, how much money you're putting into Google marketing, for example, LinkedIn marketing, etc. And then you use that as a baseline for the sales funnel. And when you're doing this, you're basically already doing a big part of your profit and loss forecasting. You're doing your OPEX, operational expenses forecasting, and you're doing a big part of your customer acquisition cost forecasting. And with this, I'm basically explaining how you're building your whole financial plan and whole financial model, not just how you're doing revenue forecasting. And when you go through the couple of different steps here, what we're explaining, you've actually built most of your financial plan, most of your profit and loss forecasting, most of your cash flow forecasting as well. And these expense analytics will basically explain or help you understand how you can burn money in a sustainable way and how you can actually build a growth engine to generate scalable revenue as well. Because startups need to burn money to earn money as well. That's usually the game here. Reima, would you have any practical tips or examples about this part here?
Yeah, actually, still maybe a bit to elaborate also that not only that you can spend money efficiently, but analyzing these in channels. So knowing that which is the customer acquisition channels, you should be pushing your efforts in. And for instance, if you look at the customer acquisition cost, which is one of the metrics that we like to look into, and how that relates to the customer lifetime value. So those two numbers basically should align so that the customer acquisition the customer lifetime value divided by customer acquisition cost should be between 3.5 and 5. Why above 3.5? Because otherwise the business is not growing very fast. This bit depends on what is the payback time. So if the payback time is really fast, talking about 1 or 2 months or even days instead of 12 months, then it might be that the lower end is good as well. But if its payback time is years, then even the 5 doesn't really make sense because it's just not growing fast enough. But also that if the payback, if the ratio is above 5, that tells you that you are not aggressive enough in your customer acquisition. You are not pushing money to all of the channels. You are leaving money on the table by not growing too fast. And this is the way of using these kind of metrics and why we use as investors. For us, it tells what is the speed the company can grow. But for you, it tells that what are the areas where these are working. So not just looking into customer acquisition cost as a bulk, but looking into based on the channel you get the customer, based on the customer cohort, based on the customer type, whatever is the feasible tagging mechanism for you to put those into different dimensions.
Great, thank you for the example. That was great. The next part is headcount and staff cost forecasting. So basically, when you've done your lead generation, then you're looking at how do you actually close those deals, and then you usually need salespeople, especially in a B2B company, to do that. And if you're a self-serve marketing-driven company, then you need to have quite a sizable marketing team usually. And then when you're doing headcount planning, then you're at the same time doing staff cost forecasting as well. And both of these, like sales headcount forecasting and marketing headcount forecasting, they drive your revenue forecasting, they drive your customer acquisition cost forecasting, profit and loss forecasting, and cash flow forecasting here. And that really kind of like explains your whole sales funnel as well, like Reima was explaining it earlier. So looking at all the different conversion rates and sales cycle lengths, for example, CAC payback times, that all impacts your growth rates, your revenue forecasts, and your cash flow forecasts as well. So basically, it tells you how efficiently you're scaling your business, so that you're not leaving any money on the table here. Okay, back to Reima here.
Yeah, and I still go back to what Niko was saying about the whether you put the resources on sales or marketing. It really goes that what you monitor, what you measure should follow that what is your business model. So if you are in sales-led growth, your business is driven by how many salespeople you have and how good they are. And of course, that they have good quality leads, but usually in sales-led growth, the bottleneck is the amount of salespeople. So forecasting how many people you can have is a very reliable way of forecasting how much revenue can have, because you know how many customers those can bring in, what is the lead time, and what are the typical revenues you get. But then if you are in marketing-led growth, then it's the marketing activities driving the growth, and usually you can measure it directly, how many euros or dollars you put in, and on which channel, and which are the returns. Then it goes totally different if you are in a product-led growth, where you actually would need to start following that, how your users are engaging and what kind of virality factors you have in place. So that is basically out of these 3 different growth models, the only one where you cannot really build on how much resources you're putting into, because on that one your resources is developing the product, and there is not that kind of direct link. One thing to keep in mind is that all investors have their own investment thesis, And understanding the investors' investment thesis means that it's easier to also understand what they are looking into in the investment target. And for instance, us at Trind, we invest in companies with consumer or community component. And one of the elements in that is that we don't like sales-led growth. We like marketing-led growth. We like product-led growth. So when, for example, I get the forecast from the company, I start looking into that how much of the investment goes to the headcount. If it goes to the headcount heavily, it's probably not the right case for us. But if it goes to the marketing, then it's probably something that we should take a deeper look into. Over to you, Niko.
Thank you. Let's go to the next one, which is sales and revenue forecasting. And Reima actually pretty much opened this one up already. So when you're doing your headcount forecasting, your staff cost forecasting, and when you've already done your, let's say, lead generation forecasting and therefore your marketing budget, you've actually pretty much done your sales and revenue forecasting as well, because this should be the end result of all the other forecasting that you're doing. So revenue forecasting, for example, drives your cash flow forecasting. It drives a lot of your SaaS metrics like LTV and ARPA, and it drives your P&L forecasting. So when you've gone through all these different forecasting elements and you've done your revenue forecasting, your financial plan and financial model is ready, and you can just ship it to anybody then, whether it's prospective investors, current investors, management team, or your board, for example. So you're not doing anything necessarily specifically for any stakeholder or third party. You're just basically doing the financial plan so that you can understand your growth potential, and that so that you don't run out of cash. And then you just in a couple of minutes send that report, maybe in a more like limited way, to different stakeholders over here. So investor reporting should be just an end product of your internal analysis and an internal understanding of what actually drives your business's performance and growth as well. Reima, would you have any additional comments on this? You explained this quite a lot already in the previous slides.
I need to take that. I hope that the investor reporting would not even be the end product, but just byproduct.
Exactly. Yeah, that's a better term. Byproduct.
So really, your core for the whole forecasting, it's a tool for you to drive the business. And I think it's really nicely summarized on the slides. Grow your revenue as fast as possible. So everything that the forecasting does is basically give you a tool to achieve this. And just to take an example on the sales forecasting, when you have good forecast in place, you can start analyzing that. Does it really make sense that we try to grow by acquiring customers? How about if we try to grow by growing our existing accounts? So we add one or two features and put an extra price tag on those. Would that actually drive more growth faster versus growing the user base? Opportunities like that you can find when you really understand that where your revenue streams come from.
Yeah, net revenue retention is key, and then upselling to current customers as well. So that's one of the key ways to growing your revenue base. So not, like Reima explained, not just from new customers, but then from your existing customers as well. And then trying to keep your churn rate really low, that helps as well. So one of the last items on the list is cash runway and burn rate. That's one of the key metrics for any startups, because we've been talking about burn and investing in growth and negative EBITDA, which means that startups need to really carefully look at their cash runway as well and analyze how much money they have in the bank, for example, in 6 months. When do they need to do additional fundraising? How are they growing their business, for example? So just a quick explanation how I would do it, basically do cash runway calculations as a CFO. So I would start with the current cash balance, and then I would analyze the historical gross burn and net burn rates, at least for the last 3 months, for example. And then once I've done my forecasting, I would look at the forecasted burn rates as well. And therefore, I would be doing my forecasted cash balance calculations, and then at the same time doing the cash runway calculation in months. So for example, if your current cash balance is 1 million euros in the bank and your net burn is, for example, 100,000 a month, then logically your cash runway is 10 months as well. So you'll run out of cash in 10 months. So you need to start preparing quite quickly. Like, how do you solve that situation? For example, will you raise more money? Will you extend your runway in some ways? But then understanding all these key elements are really important for a startup, so that you basically plan ahead, knowing that often fundraising takes on average 3 to 6 months, for example. So if your runway is 10 months, you probably need to start preparing for your next round quite early on. Yeah. Reima, how are you analyzing cash runway for your portfolio companies or your like prospective portfolio companies?
Yeah, that is actually a number that I'm not only analyzed, but that is something that we require that all our portfolio companies report. And the reason for that is that we don't want to be surprised. So, as you said, the company will run out of cash at one point, and the fundraising will take time. And we want to ensure that the company fundraises early enough, because otherwise they are in problems. And I would say that the runway is not a number that I want to know. It's, to be honest, a number that I usually hate to know, but I need to know it, because otherwise there are surprises. And good example from my angel portfolio, or bad example, how you want to put it, the company had some rough times. Our sales hadn't grown as fast as we planned. We failed to fundraise, and we took measures to extend our runway, laid off some people and so on. But unfortunately, there was a huge mistake in the forecast. So one expense that was tens of thousands of euros came out of blue. Well, not out of blue. We knew that we had that expense, but for some reason it wasn't in our forecast. So meaning that we went, by the time we got that invoice, from 3 months runway to minus 1 month runway. So that company went into a bankruptcy, and I'm not sad about it going to a bankruptcy. I'm sad about the way it did, because it still had potential, and have we not had this kind of surprise, we would have enough time to find the funding for the company and restart the business again. So it's really about understanding the runway on your existing portfolio. It's really about risk mitigation, and also you as an investor being prepared that, okay, if you need to take some actions, you have enough time to conduct those actions. Then what comes to runway, as when you're investing in a company, I would say that the company should have 18 months runway when they're fundraising. In early stages, it might be 12. But if it's any shorter than that, it means that one of the founders will use most of the time on fundraising. If you have 12 months runway, you use 6 months of the fundraising. So meaning that half of the money will not go to grow the company, but instead for look for more money. And then if you go above 18 months runway, then you are usually giving up too much equity on too low valuation. In some cases, maybe 24 months makes sense, but I would say that the 18 months is sort of a sweet spot. So also for this respect, knowing your burn, knowing your runway helps to assess that what kind of funding is feasible as for to seek in the next round.
Great. Thank you for the explanation. Let's do a couple of summary slides over here and start wrapping up. We have a couple of minutes left. So we looked at lagging indicators and leading indicators, and when you actually link those together, and when you build a full financial plan or financial forecasting, you'll probably end up having better profitability, because you understand when it's time to grow. For example, you'll have better revenue forecasting, and therefore you have better cash runway forecasting as well. You thought about all the different elements here, and then you most likely will drive company growth. You'll have happy current investors, and you'll probably be able to fundraise faster and better as well if you can present all those numbers in an understandable way, and if you can understand yourself what can you do with an extra couple of millions of euros of funding, and how will you use them, and how will you grow the business as well. And here, if you go to the key takeaways slide as well, this is actually, maybe I would leave the first couple of points to Reima here, because this is about investors looking at startups here.
Yeah, so as said, we invest in the future. So of course, that is the leading indicators should be the one that helps us to see that how it goes. And yeah, when you are approaching your investors, know your numbers. So if you have a good comprehensive financial plan, it's a lot easier to communicate, and also it's sort of a wow effect to the investor, that because I get financial plans from everything from basically something that is done by paper and something that is really high end. And when I look at the financial plans, it's not about that much of the outcomes, outputs, but I'm more interested in the process, how it's done, because that tells me the thinking of the team. And if I can see that, okay, this thinking is the team that they have really thought through, they have deep understanding of what they are doing, it's already a good guesstimate that this might be the winning team.
Exactly. Last point here in the key takeaways is that, as Reima said, that there's a lot of ways to do financial forecasting and metrics calculation, etc. Lot of companies do it manually, but there are good tools for that. For example, Calqulate is a good tool for that. There's a couple of SaaS metrics tools, such as Bear Metrics, that are really good. And then the more you can automate it based on your financial data sources, the less time you actually spend on doing those financial planning and metrics calculation. So it's better to start automating some of the elements as early as possible.
With that, we've come to the end of the session. So somebody also was asking about the recording and the slide. Yes, we'll be sending that out once the recording has completed, and also with the slide. If you want to read a bit more about, investor reporting, leading and lagging indicators, we have a couple of articles on the Calqulate blog that explain those in detail. So feel free to check them out. And yeah, thank you so much, guys, for joining us today. I hope you took home a couple of learnings. For me, it was golden. And also, thank you, Reima, for your time. We really appreciate your knowledge and sharing it with our community. And also, Niko, thank you so much for sharing your perspective on this. And with that being said, I think we can call it a day. Thank you, guys, for your time, and do enjoy the rest of your day.
Thank you, Reima. Thank you, Kelvin.
Great to be here once again.